Hey guys,
Yeah.
I
Amen.
just I just fielded a terrible sales call that I thought I'd share with you. So I got a call from, of course, a number, if you're in real estate, FYI, you should answer numbers even if you don't recognize them, even though there is a high chance it's probably a spammer. But anyways, answered the call. It was a person who had called me last year from the Trillium Group. I think they sell branded items for client gifts. Okay, so I'm sure last year I politely listened to a spiel and then told him I wasn't interested. He called me again, which I appreciate, but the conversation was started off, I'd like 45 seconds of your time. Okay, 45 seconds. I can afford that. And then he just goes to talk for 45 seconds and doesn't ask me a single question and just goes on to say how he bought a bunch of these tape measures, and these are these Stanley 25-foot tape measures, and how everybody uses a tape measure, and how it's a great gift that they're going to be looking at your face or your name every time they pull this up. And he doesn't ask me a single question. And at the end of his spiel, he says, well, what do you think? I said, well, I think I use an electronic tape measure.
Uh,
And you know he immediately goes into a defense, right? Because now he's trying to backpedal. Well, your clients don't use an electronic tape measure, and this is this, and this is why, and these are $25, and this and that. And I said, to be honest with you, I don't. And he's like, this isn't for you, this is for them. I said, honestly, I don't foresee myself giving a tape measure as a closing gift. And from there it just went downhill until he finally just got frustrated and let me go. But my point is, guys, is that this guy's probably dialing 1,000 dials a day, who knows, right, to realtors all across the country. And I truly think that he could have better bang for his buck if he refined his script and asked questions and had a more engaging conversation rather than just trying to get someone on the phone for 45 seconds just to dump their spiel on them. So just think about that, right? The next time that you're calling somebody, ask questions. Don't just try to get their attention before they hang up to give them the spiel. It doesn't mean you're going to sell them anything if they don't hang up on you. Anyways, I like it, phone calls like that. I honestly sometimes I actually give people coaching on them. It's funny. It's like my own like little personal weird thing of saying, what, you should have asked this, or you should have said that. Not that I'm an expert by any means, but it's just so funny. I don't know. Anyways,
He also made a very fundamental mistake of trying to sell you one product and leading with the product instead of leading with need or creating need or uncovering a need. I bet he's got something that you would like given to your clients, but he never got the opportunity because he tried to jam the tape measure down your throat.
it's a great point, Brent. You're absolutely right. So Brent, welcome. Brent Wilson, guys, is well, I'll let him do his little introduction. For those of you who may have seen his face around the office or don't really know who he is, but I brought Brent on. Actually, it was Sharon's idea because we want to continuously give you guys value, and we've got a group of new and experienced agents in coaching right now. And this is one of those things that I know when I sold new construction homes, I almost had to do on a weekly or biweekly basis is stay on top of what's going on in the mortgage industry. Now, I will say this, I don't want you guys to be worried about being an expert. That is what Brent and his team is for. What I do want you to know is more than the average real estate agent, and what questions to ask, what scripts to use, and what to refer to them in order to get your clients the home of their dreams. So Brent, why don't you start with just kind of a little bit of intro about you, your background, what Silverline is, and what you can do for the clients.
Yeah, thank you. Well, happy to be here. I recognize a lot of faces. I see some new ones as well. So thank you. I appreciate your time. I know it's valuable. I'm the co-founder, owner of Silverline. I've been in the mortgage business for 15 years. I say before I got into the mortgage business, I had one job out of Michigan State University, and I was kind of a hustler. Came out, looking to make money. I enjoyed sales, so I sold Coke in Pontiac for a while.
Coca-Cola.
Yeah, I worked for Coca-Cola, and Pontiac was my territory. So
Okay.
I would call on different stores in that area. And then, one time I drove through like White Lake and Commerce, and I had gotten like a small promotion to those Krogers and Farmer Jack. I was, wow, what is this place? What are all these lakes? Am I up north? And then, fast forward, I end up getting into the mortgage business, and then I move and buy my first house out on the lake in Commerce, all because I took a little detour from Pontiac back in those days. But it's been an exciting 2 years. I just got the time hop Facebook of when I announced my resignation from my previous job. I was a regional vice president at a rather large mortgage company here in Michigan, and it was just a reminder of, wow, how fast time goes. It's already been 2 years. So been working, primarily, I think I started, out of the home office, and then got some space here, shared space with you guys, and built some phenomenal relationships, and our business is doing great, and enjoy getting in front of the training groups, because it rather than, knocking on Jim DeMora's door next, right out of the gates, I thought I'd take a different strategy. Instead of trying to knock down the door of the top producers, let's grow our businesses together. Let me work with, your newest agents, because there's probably a lot of value I can provide, and outside of just, numbers, rates, and programs. And that's really, the difference. The way that I see myself is, an advisor, a coach, and, most definitely, just like you guys are, I'm a salesperson. So I think that's where I separate myself from every lender out there, is being able to control the transaction, leverage my influence to make you look better, and to make your buyer more confident in the process. And when buyers have confidence in what they're doing, and confidence in themselves, confidence in their own financing and qualifications, they're going to make decisions. Confident people make decisions. Unconfident people sit there and wait and stay on someday island. They keep renting when they're unconfident. So I like to foster a culture of confidence with my clients.
So why Silverline? You had a successful career at another company. Besides owning a business, what does Silverline do that might separate them from, a Rocket app, or my credit union down the street, or TCF Bank, or whatever?
There's a couple of things. That's a good question, and I could go down a number of avenues. I would say, ultimately, I'm a person, and I'm a person that knows what they're doing. I bet I had to get licensed for this. I chose this career. I've invested in this career. The licensing process alone, I have to go through a lot of rigorous tests, just like you guys do. I have to do 8 hours every single year to renew that. And working at a bank or a lender, banks or credit unions are actually exempt from licensing. And I tell people that's one of the first things that separates us. A person at a bank or credit union could literally be, working as an intern or a teller last week, and then boom, all of a sudden the bank, realizes mortgage applications are up, and now that teller is handling your client's largest financial transaction. And I don't think that makes good business sense. So I think experience, knowledge, wisdom, huge. As far as the company and the way we're set up, we are a brokerage. So my favorite thing about that is I can shop the market to get your client the best deals. We have wholesale pricing versus retail, which means, we don't have apps. I mean, we have all the same technology through our lender platforms, but we don't pay for $1 million Super Bowl commercial. We don't have apps. We don't have running commercials on your Speedway gas pump every time you pull in. I mean, those things cost millions and billions of dollars, and it's your clients that are paying for those things, and the consumer that's paying those things with higher rates, higher closing costs. So we can shop the market, get your client a better deal, more economical. We also can shop guidelines. So we have a wider variety of programs with, a wider variety of, instead of just having one set of rules, one set of programs.
Okay, awesome. So I like to start at the beginning, right? And, I talk to a lot of agents that are in coaching, and all of a sudden they've got somebody that raises their hand and they say, I'm interested, right? I don't know. Typically, I don't know where to start. Sometimes I get clients that come to me and they've already spoken with a lender, and that's a different conversation. But most of the time they don't know where to start. And they're sometimes embarrassed or scared or nervous about asking or moving that conversation forward. So they might say, yeah, send me some info, right? But you and I both know that there's challenges with that. So what are the first steps? And also, what are some of the scripts? Because I love scripts. What are some of the scripts and things that you should be saying in order to move that forward?
So that's a good one we can talk about. I liken it to something that we can probably all relate to. So there's one part of the process where your clients need a little positive pressure from you, and that is to get started. Just get off the bench and get into the game. We've all had that scenario where, maybe you got a little toothache or something, you've got a little pain in your knee, you've been waking up with headaches, something, you got something going on, and you should go to the doctor, but how many people have delayed that because they're afraid of maybe getting bad news, or afraid of waiting in there, or afraid of, there's this fear of just doing what is the right thing to do because it's uncomfortable. And your clients have the exact same type of mindset when they're buying their first home, and they think that the pre-approval is something that they can just do later. It's something that they should do right away. It's like getting a physical. Just do it. Get them excited to do it and tell them the benefits. So I've got some scripting, Matt, I provided that you can send out after. I don't want,
Awesome.
If we send it out now, everybody will just start reading.
No.
Trying to have a conversation, but great scripting. And I think it's got easy ways to tee it up. But really what I always say is just be assumptive and find out where they're at. You talked about the bad sales call today. We don't want to be that person. So first thing I like to do is find out where they're at. Just simple. Hey, Matt, real quick, remind me how many people you've talked, or when was the last time you spoke to somebody about your closing costs and interest rates and payments?
I haven't.
Okay, so that's easy. I didn't ask him, have you gotten pre-approved? That's a yes or no question. Very hard for me to take that question anywhere else. If he says, yes, I am pre-approved. Now I've got to ask more details, but I don't like yes or no questions in that scenario. So I say, remind me where we are. When's the last time you spoke to somebody about closing costs and rates? He says, I actually haven't. Oh, well, great. That's an easy one. I'm going to go ahead and put you in touch with my mortgage guy. He's awesome. My clients have had a lot of good experiences, and he really knows his stuff. His name's Brent Wilson. I'm actually going to text him right now with you on it. And then, I encourage people to start a warm handoff. The text is easy too. It kind of introduces everybody in a way where everybody can respond at their convenience and get the process started. And then I kind of pick it up from there and let people know the next steps.
Awesome. Let's go through those steps, because I really want to give some meat to this conversation. So I have in some of my notes pre-qualification versus pre-approval. What does that mean? Why is that beneficial to a client?
The pre-qual, I tell my clients, it's a two-step process. The pre-qualification is for your client's peace of mind. That's a true pre-qualification is really nothing more than a conversation where, we're talking about goals, payments, how much money they might have in the bank, what price range they're looking, how much they make, what they do for a living, and then we review a credit report. It can be a soft full credit report or a hard inquiry. At least lets people know where they stand. And by that time, you get all the information. You can then run it through an automated underwriting system through Fannie Mae or Freddie Mac or FHA. And they're going to based on what you and the client talk about, and You plug in the information in your loan origination software or my software, and then we run it through and it spits out either an approve or an ineligible. So if they're approved, now we're going to upgrade to the pre-approval. If they're not approved, I'm going to let them know the reasons why, and we're going to come up with a game plan of how they can get approved in 60, 90 days, 6 months. Hey, sometimes it's a year and a half, but I like to leave people with either, hey, good news. There's two things you're going to get out, one of two things you're going to get out of this call. You're going to get good news in the next steps to be qualified, or we're going to get a game plan to how you can be qualified in the future.
Awesome. So
the pre-approval, I'm sorry, to tie a bow on this, the pre-approval, the main difference, going back to the pre-qual being for your client's peace of mind, the pre-approval is for a seller's peace of mind. The pre-approval takes it a step further, and we actually collect documentation for income, assets, credit, and anything else that might be needed. So tax returns if it's self-employed, W-2s if they're employed, pay stubs, bank statements to make sure they've got all their ducks in a row.
So
and then we're going to spell that out on the pre-approval letter. It's a little fancier and it says that we've verified all those things.
So if I'm a seller or a listing agent and I have 2 offers and one of them is just a boilerplate pre-qualification subject to verification of all of these things, and another one is a pre-approval from you guys, a pre-approval is going to look stronger. It's going to give them more peace of mind.
Yeah, I always say that pre-approval is the second best thing to a cash offer.
Awesome.
When done properly.
Beautiful. Okay, so that being said, you threw out a few things that you would need for that pre-approval. Let's talk real quickly about what would I prep a client for if they're going to be getting, applying for a mortgage, or applying for a pre-qualification and a pre-approval, right? Mm-hmm. What are they going to need to provide? What is it based on? I have a great credit score, Matt. It shouldn't be a problem. I know it's not just about credit score. What would you say overall, without getting too much in the weeds, what would be the basic things that you look for, or what does the underwriting system look for in a pre-approval?
There's an acronym we use that are 4 pieces to the pie. IPAC, IPAC.
IPAC.
I is going to be income. P is going to be property. What type of home? Condo, single family. Is it a investment property, a primary residence? It's going to be all the details about the property. A would be assets. Where's this down payment coming from? Is it liquid, checking, savings? Is it a 401k loan? Or is it a gift from a qualifying relative? And then the last letter is C, credit. Not just their credit score, but we're going to take a look at the scores. We're going to pull, their debts, align it with their income so we can evaluate their ability to repay the loan, which is why we would look at like debt to income. We're going to look for any derogatory accounts or any prior bankruptcies on the credit report, things like that. And then we're going to ultimately come to a decision what program is going to be the best route and what program do they qualify for.
Okay, awesome. IPAC, income, property, assets, credit. Okay, income, just for a quick second. Obviously, they have to earn money, right? They have to have some sort of income stream. Now, what's the cleanest or the easiest type of person to qualify for on the income?
A W-2 salary and employee.
Okay, so someone who gets a paycheck every couple of weeks, who it's really consistent. Maybe they have a bonus thrown in there, but majority of their income is consistent, whether they're hourly or salary, right? It's repeatable.
Yep.
And they've been there for a year, 2 years, 10 years.
We always look at a 2-year history. Here's what, sometimes agents will think that it's a roadblock if somebody moves into a salary position like last week. Salaries, again, being the easiest, it's very easy. It doesn't matter that they've only been doing it for a week. And it doesn't matter that they just got a $50,000 a year raise. If that's a salary and it's an offer that they were given and that offer's been signed, we're good to go on that. Now, if it's like a commission job and somebody changes jobs and there's more potential there, we can't qualify off potential. We can only qualify off reality. So that's where it gets tricky, is the different types of income, salary versus commission, or salary versus self-employment.
Got it. So if I had an incredible year to date with commissions, right, but last year wasn't great, the year before that wasn't great, you don't necessarily aren't able to use this great year I've made right now, because you kind of have to look at the bigger picture.
Yeah, it's going to be, it's always going to be qualified off the most conservative amount. So most conservative in that scenario, Matt, would be they're going to take your year to date, which has been tremendous, and they're going to take last year, and then they're going to divide it by 24 months to get a 2-year rolling average to come up with a monthly income. Now, if it was like you had your killer year last year and then COVID hit and maybe you're not doing so well and your year to date is lower this year, it's not going to be a 2-year average. It's going to be based on the year to date over the number of months that we're in.
So again, they're trying to be conservative, because ultimately why? They're giving a fair amount of money and want assurance that you're going to have the ability to pay it back.
Yeah, you guys, just like me, I mean, you don't want to just sell homes and jam people into homes that you want to make sure that they can get the homes that they love and stay in the homes that they love.
Sure. Okay. So that's a W-2 employee. Real quick, where does it get wonky, right? I'm self-employed. I know I'm a self-employed person. I might make X amount of dollars, but after you do all my taxes, because I've got a good accountant, it might not look like I actually make that much money by design. What are the challenges with people that aren't a W-2 person?
Well, it's more challenging when somebody is new to the self-employed world. So if you're in your first year of self-employment, typically you're not going to qualify for a mortgage, not by yourself. You're going to need somebody else maybe who doesn't have that salary or consistency, because bottom line, self-employment has to have at least 2 years history of being self-employed. There are sometimes extenuating circumstances where if you've got enough good things where you can get an exception and get away with 1 year. So if you've got a really high credit score, you're putting down 20%. We call those positive compensating factors. So that one would be if somebody's got an 804 FICO score and 1 stellar year of self-employment, and the self-employment is also in a field that they spent the last 6 years working in, and then they've also got $100,000 in the bank. That is something that we could probably get an exception on. But general rule of thumb is 2 years. It does get a little bit more challenging with self-employment because you're digging deeper into tax returns. Things aren't always as clear as just a W-2 and pay stub. You might have an accountant who got a little aggressive on the write-offs, or maybe, just there can be more fluctuations in the income too.
Got it. Okay. So we could probably teach a whole class on this, but I want to keep moving forward. You had said debt to income ratio. Pretend I make a ton of money. I saw this years ago in real estate. You saw this too. People make a ton of money. They've got a great credit score, but they spend all their money. They've got
they got 5 cars.
They got 5 cars, a boat payment, all these, but they pay them on time. They've got a great credit score, right? They make good money. What are the challenges with that? You said debt to income ratio. What is that? What does that mean?
So the standard is, for a conventional mortgage, you got to be under 50% in most cases. 50% debt to income.
Okay, what does that mean?
That means your debts, including your new house payment, coupled with everything else. It's not going to throw in your cell phone bills and internet cable and groceries and gas, but your actual debts where you owe creditors, like your car payments, your credit cards, personal loans, things like that. Those are going to be factored in with the payment, and it's going to be matched up against how much income you bring in. Not how much income you take home, but they are going to use your gross amount. So really, when you think about 50% after tax, that person's really closer to 80-85% debt to income, even though on paper, they might only be 50%. That's why they kind of draw the line there.
So in other words, if I gross $60,000 per year, right?
That's $5,000 a month.
$5,000 per month. We know I don't take home. I got medical bill, insurance. I've got 401k contribute, but they're going to use that number, that gross amount, that $5,000.
Yeah.
An absolute high-end limit on a conventional loan, you said, was 50%. So in other words, $5,000, 50% of that is $2,500. That $2,500 has to encompass my new house payment, as well as the other debts that they're going to see on my credit report. Car payment. What you said, credit cards. Well, what if I don't pay my credit card off every month?
Every credit card has a minimum payment listed on the credit report based on the interest.
Got it. So it's
the same minimum payment you see on your bill is the same one that they're going to report on the credit report.
Got it. So like you said, that $2,500, it has to encompass everything. You know, the lender, if I don't have any other debts, the lender might say, yeah, we can lend you an equivalent of a mortgage with a payment of $2,500, but I might be saying, oh, there's no way I would want to pay that with my income, right? I have to know. So it's not necessarily the lender just telling you what you can afford. It's telling you, they're telling you what you can qualify for. And then your client really has to take a look at their budget to determine, is that something that they're comfortable spending? And that was one of the problems with, the mortgage crisis, right? People were just taking loans for the max that the lender could give them. Right?
Yeah. It's very rare that I approve somebody for their max. I try to get better in tune with their comfort zone and their budget that they've given me. We kind of narrow down a payment budget. Sure. Then I tell you, hey, listen, if you want to go $50,000 above what we're talking about today, you would qualify. I just wanted to let you know that. So if you're out there and you see something you fall in love with, I want you to know you could have it, but let's rework the numbers. Got it.
So I just want to tie a bow on that one. So your job is to qualify a buyer based on what they can, essentially the payments, right? Because we talk about the price, but ultimately for you, right, it's about the payment. Is that correct?
Yeah, it's about the payment and the down payment are really the two big factors. Do they have enough money in the bank to put the down payment down? And can they afford the payment?
Got it. So if I've got $10,000 saved and that's all I'm using, and that's enough to cover my down payment, are you going to be able to give me a loan?
No, we're going to have a conversation about, hey, listen, I can probably get you approved, but we're going to want to talk to Matt and see how good a negotiator is, because you're going to need seller concessions in order to qualify for this mortgage, because there's three things that make up cash to close. And down payment is just one of the three. And then I'll go over the other three. The second is going to be your closing costs. I can estimate those right now. Those are going to be like your appraisal, title work, any lender fees. And then the third is going to be your escrows, taxes, and prepaids. Paying your first year's homeowner's insurance, establishing an escrow account to make sure your taxes get paid next year and insurance when they're due. And then any prepaids or tax prorations, things like that.
Got it. So you mentioned closing costs. I get this a lot. Is there a way just to say blanket, closing costs will be X percentage?
No.
Is it $5,000?
The rule of thumbs, percentages are not true and they're not accurate. Sometimes you might be able to guess it's 2% and it works out, but it's not it's not a science that you can rely on by doing it that way.
Got it. So what's the best way to determine what my closing costs will be for a particular purchase?
Have them speak to me.
Okay. Trick question. All right. So you had mentioned previously a couple different things, loan types, right? Conventional, you said FHA earlier. I know that people hear VA loans, a lot of talk around MSHDA loans. Our big buyers are jumbo loans. What do they mean? What is a kind of a quick kind of overview in terms of what all these mortgages types mean, and how does a buyer, or how do I know, what makes most sense for my buyer?
Right. Well, I can go through them one by one. Conventional is going to be like your standard vanilla ice cream type of loan. It's plain. It's not fancy. There's, very consistent guidelines to follow. And it is backed on the secondary market by Fannie Mae or Freddie Mac. Those are the two big conventional insurers.
So that one is, so that one's a typical, if I've got a consistent income, I don't have a super high debt to income ratio, my credit scores, good or great.
Yeah. No prior bankruptcies. You can go up to 97% on first-time home buyers, which is
So
nice. You can do a
so
3% down payment.
3% down payment with the conventional loan. So that's even less than what FHA allows.
Right.
Right. Okay,
That's
great.
relatively new.
Awesome.
It used to be 5% for a number of years. Before that, it was actually 100%, but that was during the days that we don't want to go back and talk about.
Yeah. And are these interest rates typically, is it a 15-year, a 30-year? Is there different variances?
There's every term basically between 10 and 30.
Okay, awesome.
10, 15, 20, 25, 30. And some companies even have like a conventional, like Quicken and Rocket branded as a Yorgage. So you could do like a 27-year fixed.
Okay. Interesting. All right. So FHA, that's probably the other most commonly heard one.
Yeah.
How is that different?
FHA gets a bad rap, almost like it's the Walmart of mortgage products, and it really shouldn't be because there's a lot of value there. I bought my first home on FHA because it's more lenient. Like when I graduated college and bought my first home, a year and a half later, I paid my bills, but all I had was like one car payment and one credit card. I didn't have a lot of history. I'd only had that stuff for a year and a half. So my credit score was probably in like the high sixes. And I was, 23 years old. 23 years old, I really only had 1 year to save money. So the FHA made a ton of sense. It was more flexible on job history. It was more flexible on credit score, and the rates are still comparable. Now, it does have an upfront mortgage insurance premium. That's how the FHA program gets funded. And what I tell clients not to worry about that, though, because that upfront mortgage insurance premium is financed in the loan. They don't have to bring it out of pocket. That's usually that upfront mortgage insurance, for a little bonus advanced knowledge, is 1.75% of the loan amount.
Awesome. So what is the down payment?
Down payment is 3.5%. What's also nice is a conventional. Let's say your client had had some hardship or went through a Chapter 7 bankruptcy. They're not going to be able to get conventional financing for at least 4 years. FHA only requires a 2-year time since the bankruptcy discharge.
Interesting.
So it gets used for that a lot too.
Okay, so you said the rates are comparable. This is 3.5% down. You said there's a conventional as low as 3% down. If I could qualify for the conventional versus the FHA, why would I potentially want to go with the conventional route versus the FHA route if I have around the 3% and I qualify for both?
Yeah, conventional is going to be a strategic move, and that's what I always think. This pre-approval is not just qualifying; it's setting up a strategy to make that buyer successful. So, if I can get somebody approved conventional, I know that in a bidding war, they're going to stand out against the FHA offers, and that ones are always going to be accepted a little quicker because they're more lenient on appraisals. That's really the big reason is FHA tends to be a little bit more tedious on the property inspection than a conventional. Also more paperwork.
Got it. So pretend I'm a listing agent, right? And I'm not real versed, or I've had, a bad experience in the past. And I advise my client, my seller, no, you don't want to take an FHA buyer. The inspector, the appraiser is going to come out and criticize the house, and you're going to have to make all these repairs. Talk to me a little bit about what that means, right? This is separate than a property inspection, a private home inspection that a buyer can have that with an FHA or VA or MSHDA for that matter. The appraiser is also not just looking at the value of the home, but also critiquing the home itself for a few things.
Right. So FHA is going to make sure that everything's finished. Like you can't have an ongoing project. And a lot of times you can't do that on conventional either, depending on the level of intensity of the project. But even simple things like, are your stairs the proper height between each stair? Do your stairs have handrails? Cracks in the driveway, even where sidewalks have uneven, things like that. I've seen it. The biggest one is peeling paint on the windowsills. You can't have peeling paint on any part of the property on an FHA.
So if I'm representing a buyer who's going FHA, the FHA appraiser comes out. We do our private inspection. It's fine. It's a good house. Maybe a few things the seller's going to fix. But then the appraiser comes out and the appraiser makes note of those things. Can my buyer just be cool with it and take it?
It's not about that. It's not about them.
Mhm.
It's about what the appraiser says, and if it gets marked as is or subject to. FHA, they're a lot more likely to market subject to for those things. Subject to means it needs to be completed and then re-inspected.
Got it. So that's part of the reason we use with our purchase agreements, right? This FHA addendum that states that if the FHA appraiser says things have to be fixed, the seller has to fix them in order to close the loan.
Yeah.
Okay.
What's
VA.
also nice about FHA and VA is they go up to 57% to 60% debt to income.
Okay.
So it's also more lenient in that aspect. We have some questions in the training room too.
Hey, I see some hands.
Okay, so forgive me if I'm going off topic. Can you explain the difference between the FHA and conventional, like as of now with the whole eviction and the things with the government, which one, I guess for client purposes, is protected when they did like the whole, was it the forbearance thing?
Oh yeah. That was all encompassing actually, both conventional and FHA. That option was available for people going through hardships during the COVID. Well, actually, the reason I wasn't a big fan of it is because this time you didn't have to prove hardship. So a lot of people, my message was, I got very proactive to try and tell people, avoid that at all costs, unless you are in dire need and have to, keep the roof over your head, take advantage if you absolutely need to, but don't just, take advantage of this program because it's there, because there are repercussions that might not have been outlined in that plan. Like I've had clients try to buy a new house or try to take advantage of the lower rates after they've done that forbearance for 3 months, and they're not eligible because that has to be caught up and paid off before you can apply for a new loan. And that was one thing that wasn't publicized.
So PMI real quick, mortgage insurance, right? PMI stands for private mortgage insurance. I know a lot of people, used to think you have to put 20% down or else you can't get a loan. And then they came up with all these different programs allowing lower down payments, but you would have this PMI. What is that, and how does that different depending on the amount of money that you put down? And when does that go away?
Well, private mortgage insurance protects the lender. It doesn't protect your client. So it's an insurance product that basically protects the lender in case of default due to the lower down payment, because there's not enough equity technically to sell that or go through a foreclosure process if worse came to worse. That's why PMI exists. So PMI is not the devil. PMI is actually what allows you to buy a house without putting 20% down. On FHA, the PMI is standardized, meaning it's like a percentage and it's the same no matter what credit score. The only thing that really changes is it does have different tiers based on loan to value. Conventional, this isn't with everybody, but with the lenders that we use 3 lenders that have credit-based PMI. And it's an incredible feature because now, instead of like it was 5-10 years ago, where you'd buy a $300,000 home, put 5% down, your PMI was going to be like $225 across the board in that price range. Now it's credit-based. So if somebody puts 5% down and they've got 800 credit scores, their PMI, they're rewarded for their good credit. their PMI might only be $40 to $50. So that's another reason I like conventional on purchases versus FHAs. They can be more economical.
Got it. So real quick, if I get a mortgage and I get an FHA, loan, I've got that PMI. When does that PMI go away?
Never goes away on an FHA.
What about a
most
conventional?
people on a conventional, it'll go off automatically when you get to 78% loan to value, or you can call your servicer and have them remove it when it gets to 80%.
So in other words, if I took out a $200,000 purchase price, once I've paid off at least
To get below the 80%. Yep.
Got it. So $160,000 as I chip away at my mortgage balance, that'll be able to go away. But FHA doesn't go away. Okay. So how could I get rid of it if I was in an FHA?
I tell people, hey, just like this is your starter home, this is also a starter loan for you. So don't think of this just because it's a 30-year fix that you're married to it for 30 years. There's nothing in life that you're usually going to be married to for 30 years. And even marrying your wife, it's a 50-50 shot. Throwing a little joke there, they usually get it. And then what I tell them is, hey, we're going to keep an eye on this, and we're going to keep an eye. I suggest monitoring your credit when X, Y, and Z happens. Let's check in. We'll do a mortgage checkup, and we'll refinance this into something that might be more financially advantageous.
So they could be in an FHA mortgage and actually refinance into a conventional, even at a same or a higher interest rate, but it still makes sense for them big picture.
Yeah, it can.
Okay.
It
awesome.
definitely can.
Hey, this is all great stuff, but I want to make sure I have time. There's a few people on here that I think had a specific question. So I would love to open it up to them to make sure we answer these, and we could probably finish this up with like a 2-parter at a future date. But Megan, was there anything specific in the mortgage world that you have run across or that you had questions on, or anyone else for that matter?
Yes. Can you hear me?
Yes, we can.
So, for the actual process, I was curious, what's the difference between like a loan officer versus a loan processor versus the underwriter?
Oh, good. That's a great one. So there are actually 3 very different rules. Loan originator is going to be loan originator, mortgage banker, loan officer. Those are all the same. They're just different terms. And that's the person that takes the initial application from the client and then negotiates the rates and fees and presents them. That's the one who gets the process started, gets the commitment, and then submits the loan to the lender. The processor is actually a liaison. You guys might call it like a transaction coordinator in your world. It's somebody who helps just facilitate the necessary documents. Basically, the loan originator submits the loan to a lender, and then it goes to an underwriting team. The underwriter checks everything necessary to close that loan, and then checks what's been submitted at an initial application, and then produces a list of outstanding items or items that you've submitted that need further documentation in order to satisfy. The processor's job is to take that list and then communicate it in a digestible way to the client, keep them updated as we go, and to do it in a way that also makes, logistical sense, like ordering the appraisal after the inspection, telling them when to start getting their homeowner's insurance lined up and when they can bind the policy, starting to get their assets prepped and giving them wiring instructions. And then just to let the processor, the processor is employed by Silverline. I have 2 really high level processors. The underwriter works for the lender, and the originator can work for the lender or independently.
So is a client going to have much communication with the underwriter?
Not at all. None at all.
So
they'll have communication with the loan officer and the processor.
Got it. Megan, does that answer your question?
Yes. Yeah.
Okay.
So explain exactly what the underwriter does and why we're all so afraid of underwriters.
Because they're like, it's like an attorney litigation. It's like the loan officer, processor, and real estate agent all want what's best for the client and want things to go smoothly. The underwriter's job is to look out for the bank's best interest and to make sure that everything's satisfied so that the bank doesn't end up on the hook for the loan. So their job is to scour, break out the microscope, fine-tooth comb, whatever metaphor you want to use. But yeah, they're like an auditor. They're auditing your file.
The best one is going through bank statements and seeing a deposit and wanting to track down where that money came from.
Yeah.
Right? Because at the end of the day, they're protecting the bank's interest, making sure that this person does have the ability without any outside influences to be able to pay that loan back.
Mm-hmm.
Quickly tell us then, the underwriter finishes their job, and when they're all done, they put a big rubber stamp on it that says clear to close. What does that mean in reality to us?
So yeah, a lot of times there'll be like an initial underwriter and then a senior underwriter that will basically then double check the first underwriter's work and then issue the final approval once the preliminary CD has been acknowledged and all documents and title work has been submitted and supplied. Once they issue a clear to close, then the loan is now in line to get scheduled with a closer, transaction coordinator, basically, or processor. Depending on that, that's a little bit more unique based on who you're working with, the listing agent. Some people have transaction coordinators, some people don't. But basically, that's the time where like you're good to go. Nothing else. Rarely does anything else, come up underwriting wise, issue wise. You're basically home free. That's like where you can start to. I never light the victory cigar until after, but that's the next best thing. The clear to close is the next best thing to actually closing.
So this is an important point, right? So we all put a closing date, right, on a purchase agreement, on an offer, sometimes a range, right? Leading up to that date, there might be no news for a while, and then all of a sudden we need this, right? They need this document or everything we have everything and we're good. But that doesn't necessarily mean we can close, right? It means that we can submit for final approval in order to get that clear to close. And then how quickly can we close?
Yeah, it used to be like, hey, it is dependent on the environment. And right now, you've got a whirlwind of things going on. You've got the lowest housing inventory that we've, I think, ever seen, which means high demand on purchases. And but it's still like a hot market. There's still a lot of transactions taking place. And you've also got that coupled with historically low interest rates at the same time, which means there's a lot of refinance applications in process as well. So getting clear to close doesn't mean like, boom, it's an automatic, like we can sign this later today. Clear to close means we're now in line. We can start looking at dates, usually a couple days out in getting a schedule. Clear to close means we can now pick one of those dates inside the range map that's on the purchase agreement that we want to coordinate everybody to sign.
Got it. So if I was right now representing a buyer and we were putting in an offer in a home, what would be the dates, the range that would be realistic, but also, not unrealistic in terms of a closing range? It used to be, how long ago was it when lenders were saying we can close it in 2 weeks, right? Would I put that in a purchase agreement? Would I put that in?
No, we wouldn't want to promise that right now. And the same token, I know that you don't want to go right to 45 days because again, you got to know the seller's motivation, and that could be you don't want to take yourself out of the game right out of the gates. But I've heard stories, and I've picked up a few clients from my father that are actually in process with other lenders that can't close for 60, 90 days right now. And I pick them up and we're still closing in 30. So 30 on purchases is completely acceptable right now. FHA, you might want a little bit longer, but I would still like negotiate 30. And then I just try to set expectations, as we're midway through process. If there's going to be any delays, hey, let's just push this one out now by about a week. And I'm still going to fight like hell to get it done in 30 and hopefully surprise everybody. But I'd rather have it be a happy surprise than a negative one at the end.
Yeah, I agree with the under promising and over delivering.
Mhm.
What other questions? Kai, Sharon.
I have a question and a comment. The first one is, Brent, as a broker, isn't that like 30-day versus 45 or 50-day dependent on who you end up going with, like who you pick?
Yeah, that's it. Yeah, that's another good one is a good question, because yes, it is. And so that's the nice thing about having 9 different accounts is I can clearly see every one of them discloses their turn times for initial underwrites and condition clearings. And it doesn't mean those turn times are going to stay the same the entire way through process, but it gives me a good indicator of what their volume is like. And, do they have the right resources? And sometimes it's just better to go with the one that has just the best process flat out. Even if they're a little bit higher on price, I can let my client know the reason we're going with this one, and they usually understand.
So we all know, well, some of us know that there's still like a whole nother section of weeds, so to speak, to go through, right? Before you get to that final, we're going to sign today. Are you available to come back next Thursday to hit some of those more detailed options?
It depends on the weather.
What?
Might need to sneak into a tree stand. Marsupial can relate.
Well, how about your next available Thursday? Can you come back and we can like pick up where we left off?
Yeah, of course.
Underwriting.
Anytime.
I got one more question I want to have answered. It's along these same lines. Is from Michelle. She had, anyone who's had a deal, right? You hear about this 3-day rule, right? This clear to close, 3-day rule. Briefly describe that. Well, what does that mean?
So this is again, this is probably, depending on how you feel about the government, there is some things that I think the government has good intentions, but then they just don't have enough business knowledge to make the decisions they make. I kind of think the TRID rule is one of those. They did that. That was adopted to prevent, people from getting taken advantage of on a loan. So good intention, but it's more designed for I think it's applicable on refinances, but on a purchase, sometimes you got people in moving trucks and there's just a lot more on the line. I don't really like the TRID rule, but it is there. We can't fight it. We can't change it. You just got to know how it works. And basically you've got the TRID rule. It protects consumers because it requires them to get their closing disclosure 3 days before they have to actually sign it. And so we try to get that out as soon as possible. We've actually gotten really good at getting those out early, but it is something that if your underwriting conditions aren't clear and you can't get that out, it can delay the closing because it's got to be acknowledged by your client. It can't just be sent to them. They've got to acknowledge that they received it. And then the time will start. So if they get that if they want to close Friday, let's say of this week, that closing disclosure needed to be signed by midnight or 11:59 on Tuesday.
Okay, well, I had a closing that they got it the morning of closing. So I guess I'm curious to know why that is.
Yes, good question. So what happened in your situation, Michelle, is they got their final CD the day of closing. That's okay.
Okay.
The preliminary CD is what has to be acknowledged 3 days before. And the preliminary and the final are not always dollar for dollar the same. They're pretty darn close, but usually what's missing is the title companies doing their balancing and getting all the taxes and insurance figured out.
Okay.
So it used to, back, during the heyday, people would been given this big packet of information right before closing, didn't have really a chance to read it, didn't really know what they were signing. Their loan might have had an adjustments or prepayment penalties or all the other hidden things in it, right? So this was enacted in order to give them time to review everything prior to being able to close, so they weren't, kind of taken advantage of. And what you're saying is, that has to be sent to them and them acknowledging it. Now, 3 days prior, it's 3 days, including Saturdays, not including Sundays, and it's not 72 hours, it's 3 days. So
Yeah.
even if you said 11:59 on Tuesday would allow them Wednesday, Thursday, close on Friday.
And Matt, I sent you this, Matt, in an attachment so you could send your group. It's like a cheat sheet of
Awesome.
what day you want to close of the week and what day it would need to be signed.
Got it. And just to recap what Michelle had said, they're sent that 3 days prior. They have to electronically sign it, acknowledging that they've received it. But that does not mean that those dollars are the definitive fixed amount. And this is where a lot of times people have a really hard time understanding. I got this. If it's not accurate, why am I signing this?
Mm-hmm.
It's because part of it is because not everyone has contributed their fees, prorations, and final numbers to it. Doesn't mean your interest rate could change. It doesn't mean your down payment's
Your
necessarily
rate's not
going
going
to
to change.
Yeah, but we
Rate
don't know.
can't change. Otherwise, that if a rate changes or the fees change in a way that are more than 1/8% of the overall annual percentage rate, that adds an additional day of redisclosure.
Got it.
But if it's just your normal tax proration type stuff, you don't have to re-sign it.
Got it. So maybe we'll spend a little bit more time going over that process, basically from application through underwriting and appraisal, cover that a little bit. But in other words, a buyer is not necessarily going to know their exact dollar amount that they have to bring to closing or wire until maybe the day of. And that's just reality right now.
We try to get it out 2 days, but it just doesn't happen right now with the volume. It doesn't always happen. I love to have people, because I get it. It's a big transaction. You want to know. What we do though is we do overestimate up front, so that usually people aren't getting like sticker shock where things change by $3,000 or $4,000 at the end. It's still going to be within the range they started, and as long as they have the money, I mean, a couple dollars one way or the other, people are not usually angry. They're glad to know that they're closing and that they're okay.
Any other questions or anything? I know, again, there's a litany. This probably could be a multi-part class, but again, the important things are surface level for me to make sure that you guys are familiar with these terms, right? Also make an introduction to Brent. He's happy to talk with anyone. He's in the office. I don't know how, you don't have a necessarily set schedule.
Usually every day now.
Awesome.
Yeah. Yep.
Now that the kids are back in school.
Yeah.
And him and his team are in the office, and been doing this for a long time. So even if you just have questions, guys, hit him up. He's happy to answer them. Anything else before we go?
I'd be interested in because as the days to closing are probably the most stressful, and I guess when it comes to working with the buyer, maybe trying to kind of share with us maybe some tips on how to advise them as they're waiting for the CD or that seat, the clear to close or whatever it is. I just know that it's just, if there's any way that you guys can maybe just suggest that to us as newer agents or just agents that are working with buyers during this crazy time.
Yeah, Sharon and I actually talked about that exact topic about, I don't know, it was probably an hour ago. And I said, that's the big thing. It's not knowing everything, it's knowing how to have the conversation and deliver it in a way that keeps everybody calm and confident.
Yeah, because if you get a phone call from your client says, we haven't had first final numbers, and you're like, oh my God, why haven't you? And then you freak out, right? Rather than being able to, set the expectation up front. That starts with a buyer consultation, and again, repeated times throughout the process. And then again, hey, remember we talked about this, right? This business is a lot of hurry up and wait. And I love being able to be proactive those final weeks, those final days, to be able to really stay in front of it. And it's not, I know I hate no news is good news, because that doesn't ease anyone's mind. It's consistent touching.
We have the reverse saying here. We say update them even if there is no update.
Yeah, I love it. Yes, that could be a really stressful period of time, Michelle, especially when you've got antsy buyers that are, specifically engineers and the type of people that need to know everything. Setting proper expectations and under promising and over delivering is really key. So anyways, appreciate Brent. Thank you guys for showing up for this. Hopefully it was beneficial. It was on the list of things that you're looking to learn more about, and we're going to continue to pour into you. those things. We'll probably ask Brent to come back for round 2 and kind of button this up. Again, you don't have to wait. If you have any questions, Brent is.
Yeah, I'm gonna go hit up the food truck.
Okay,
Anyone's
awesome.
gonna be there.
Awesome. So if you see him in a blue shirt down there, ask him whatever questions he has or you have. No, I promise, no stupid questions. So thanks again, Brent. See you guys. I'm sorry I can't make it to the event. I am stuck at home with homeschooled children as we quarantine for the next week and a half. But as always, let me know if you guys need anything. I'm here to help you. Thanks.
Thank
Yeah,
you.
thanks, man.
Thank you.